So the first thing I want to start off with is talk about accounting and finance. I'm talking about accounting and finance from a statement standpoint and as it relates to investment. But I want to be clear on a couple of things, okay? Number one, financial information is really helpful for you as an entrepreneur, as a business leader, to keep a thumb or a knowledge of how your company is performing from time to time. So as I've written here, and I don't like to read what I've written, but I'll go through them quickly. Financial information is helpful to help an investor evaluate the success of the business. Now, that doesn't mean that you have to be making profit all the time. It just means it helps them to understand how the financial performance reflects the strategies and business decisions that you make from time to time. It's financial information, within the context of an investor, is also used as a comparative set of information to your competitors, as well as the historic performance of your company over time. Are you improving? Where are the challenges? Where are the successes? And as I said before, it helps you as an entrepreneur to stay on top of your business with respect to, I'll get to the next slide, but 3 fundamental areas: the assets and liabilities that you need to manage, the sales and expenses that you need to generate, and the cash flow, which is a critical component of your success. And what I mean by that is not going bankrupt as you progress and as you actually roll out your strategy. But I want to make sure people are clear on this. The financial information is only one of several other important key metrics for you as your business, as you judge your success or as you look for investors. And so if you go to the other side of this presentation, you can see that the financial information is important, but it's not the most important. What's really important in a business, especially when you're talking about yourself in growth or attracting an investor, is that there's a leader with vision and passion as a founder of the company, and that you are fully committed to the success of your company. And there will be times in which you won't be as successful as you'd like to be, times in which you will be more successful than you anticipated. The real critical key is to recognize that don't get overly concerned about problems, and don't get overly confident when you have success. You need that vision, you need that passion as a founder that investors are going to want to see. They're also going to take a look to see, do you have a product or service that is desired by the customer? And again, does the marketplace accept you? Is there a desire for what you have to offer? Are there things that really look like there's a future? And they call this scalability in the investment terminology. And what that scalability really just means, can I grow? And can I grow vertically? Can I grow horizontally? Can I go to other countries? Do I have a big marketplace for which I can actually penetrate with the service or product that I have to offer? The other thing that an investor will look at is the core management team. And that means yourself and then the 1 or 2 other people that are critical to you. Depending on the size of your company, it could be a team of 1. If it's a little bit larger, it might be a team of 3 or 4. And if it's a mid-sized company, it might be a team of 10 or so. And how you've organized that company to help really achieve the strategies you want to set out are really important for you as a visionary, as a founder, to demonstrate and articulate to an investor, to yourself, this is my core team, this is why I'm successful, this is what they do. But it's not just something that you just want to add as a PowerPoint presentation or a set of slides or a document. What you really want to be able to do, and this is where investors will really understand if you know your business, is to be able to tell about your product or service via a story. Storytelling is the best way to communicate across to an investor what it is that you do, why it is that you do it, and why it is that they should invest in it based on the success that you see, knowing that you actually have also internalized the fact that there'll be issues, there'll be problems, and you use several different ways to measure and react to a downturn, or so you can reduce the issue of a downturn, or actually take advantage of a success that you may not have anticipated. Because all startup businesses have a whole lot of uncertainty. And the key is the uncertainty exists, the marketplace exists, You have vision as a vision and passion. You have a management team, and you have a set of metrics that you can actually monitor your performance and make the changes you need to make. Today, I'll talk about the set of metrics that relate to financials, but there are other sets of metrics that you should also want to consider. Accounting uses. I like to tell people that accounting or financial statements is nothing more than the language of business, okay? And every language has verbs, every language has nouns, and every language has adjectives and adverbs, okay? And they are basically, the purpose for this is for you to control your cash, for you to measure your success, and for you to monitor and manage your assets, okay? But on top of this, it allows the investor to take you as an entrepreneur, an investor as a possible investor, to take these financial statements and look at them against other opportunities that they may have presented to them to make investments. So your financial statements are one component of you telling a story to an investor and showing the results of that story through your financial statements so that they have more faith or confidence in you as an investment as opposed to somebody else. Now, in the financial statements, there are three distinct financial measures, three statements within the set of financial statements. One is the profit and loss statement. I believe in Nigeria and the UK, they refer to it as revenue. Turnover. In the US, we refer to it as revenue. And then under that revenue is all the costs that you incur to drive that revenue. And so you take the revenue, let's call it $1 million, and it costs you all in all $800,000 to generate that million, which means you have a profit before taxation of $200,000. Now, that by itself is not sufficient because we don't know against your competitors if the $200,000 is good or the $200,000 is bad. And you should be looking at it historically, what you did the prior year, the year before. But this actually tracks, this is what we call a periodic statement, okay? You do this every period, and the typical period is 1 year. So you track your performance on a year using your profit and loss statement. The next statement is called the balance sheet. In the balance sheet, and we'll get into some detail of this later on, and I know it's going to get, I don't want to get too deep, but I just want you to understand it. So as I talk to several of you over the next week, I can explain how you can actually build a set of financials to monitor and manage your business. The balance sheet tracks what we call your assets, and assets include cash, it includes inventory, it includes equipment, it includes desks. All those things you paid for and you actually put out money for gets recorded in the balance sheet, and this is what we call a perpetual statement, which means you don't stop it from year to year, it just keeps on running year after year after year, and it gets updated with the profit and loss statement performance, because there are other things that go into that. So the balance sheet contains the asset side, it contains what we call the liability side. A typical liability might be a loan from a bank, okay? Or it might be what we call accounts payable. You buy some stuff from a vendor on credit, you owe them some money, you record it here in the balance sheet. This keeps track of all the money you've got coming through on your assets, your liability side. And then the third statement that ties these two together is what we call the cash flow statement. This makes sure that the profit and loss statement and the balance sheet are synced up. And the cash flow statement helps to do that in addition to actually having you be on top of your liquidity. And your liquidity means the cash you have to spend, because the cash in the bank is the immediate cash you have available to yourself, but you have obligations and you have expectations. And so the cash flow statement helps you to manage that so that A, your profit and loss statement and your balance sheet reconcile, and you have a picture of the cash on hand to validate indeed what it is that you have for what we call liquidity. So you determine how much time you have left in your business before you run out of cash and need to generate additional cash to stay what we call solvent. Solvent just is a fancy term of not going bankrupt. And so this is just some examples of a balance sheet, a profit and loss statement, and a cash flow statement that I wanted to put on here and show just in a visual way how they relate to one another and how you use them. On top is an example of a profit and loss statement with some historical information. And again, depending on the business, we can set the profit and loss statement up in a particular way so you can track groupings of expenses, groupings of revenue, what they call cost of sales, and then other things that go on. The balance sheet keeps track of your assets and liabilities, and then the difference between assets and liabilities becomes your shareholders' equity, or your equity in your business. That just means all the profits accumulated through the years that you had your business. And your equity starts off with, if you put $100 to start your business, $100 goes into what we call cash and cash equivalents, and then 100 goes into what we call common stock. Okay? And then again, I go back to the cash flow statement. The cash flow statement is how I keep track to make sure that both the balance sheet and the profit and loss statement is in sync. And when investors take these documents and look at these documents, they look at them to see if they're accurate. They look at them to see if they tie, so there's no holes in your financial information. And they look to see if this is a reflection of the performance of your business as you state your strategy, as you state your vision, as you state your objective, and as you state the products and services that you offer to the customer. So I'm going to stop for a second and see if there's any questions or comments from anybody. Don't be shy, because I could talk for a long while.
So we have one raised hand. We're just going to bring Peace. We are assuming you have a question. We're just going to bring you up so that you can ask your question. So Peace, you just need to unmute yourself and then ask your question.
That was actually done in error, but it's been an educative lecture. So thank you. We can actually go on.
Okay.
So what was that, Lohi?
It was an error. So we don't have any questions just yet. And everyone, like we mentioned before, if you have a question, please drop them on the comments box or through the Q&A, and we'll just push them up to Terry. And we also mentioned on the chat, if something is complex or complicated and you need Terry to clarify a little bit more, just make a mental note of it or drop it on the chat, and we will go right back to it so Terry can continue.
Let me ask the group a question. How many in this cohort are familiar with these kind of financial statements?
So you guys can respond on the chat or just raise hand. Okay.
And how many of you have actually used financial statements to go to the bank for a loan? Because there's a difference between a bank and an investor. An investor will take risk. A bank is risk averse. So a bank will rely on the accuracy of these statements and the ease of reading these statements and the demonstration that these statements are accurate far more than an investor, because banks are risk averse or lenders are risk averse, whereas investors are not so much risk averse. So how many of you have actually used financial statements to go to a bank for a loan or something like that?
So from the previous question, 2 people are familiar with, we have the show of hands from like 2 people familiar with financial statements. So, and everyone, if you are used to using financial statements, okay. So someone on the comments says she's a little bit familiar with these terms and have tried to use them in getting a loan before. And somebody else says she's not in this department and haven't used it to take a loan. So I guess we can.
Okay, so I'm going to start with the profit and loss statement. Let me see if I can get this forward. Okay, the first statement, which is going to be, which you're probably most used to, is what they call the profit and loss statement of, in this particular case, I used Amazon. They call it a statement of operations. And it's actually to record the actual performance during a specific period of time. In the particular period that most companies use is 1 year. But you can do it monthly, you can do it quarterly, or you can do it yearly. And this one's laid out quite nicely, but as I said, each business has to determine its own profit and loss statement to set up. And all you really want to do is at the top, you record what we call net product sales or net revenues, okay? And then you have another thing called service sales. So in this particular case, there's 2 types of revenues coming out of this particular business called, again, this is Amazon. From what date, I'm not quite sure, okay? And it does a comparison, well, it's actually 2017 because it stopped there. And so it does a comparison between 15, 16, and 17, which shows how the business itself has grown over the years. Then it shows 2 types of revenues, the product sales and the service sales. And then you have the total net sales. And that is all the revenue that you're generating, which doesn't mean that's necessarily the cash you generated in that particular period, but it shows this is the performance of my business in selling my product or service. Then you start taking all the costs of driving those sales out from the revenue. And as you can see in this, they look at cost of sales. Cost of sales is usually the product costs. So if you, an example, if you sell coffee cups and you sell them for 100 Naira and it costs you 50 Naira, what ends up happening is you get 100 Naira of revenue and you got 50 Naira called cost of sales or cost of product sold. Then you've got other types of costs that go along with that sale of that coffee cup. Part of it's fulfillment, which means you've got to store it and pay a warehouse to store the coffee cup. Part of it's going to be marketing, which means you spend some Naira to actually tell people in the marketplace, hey, listen, I have a coffee cup for sale. You should buy it. Could be a billboard, could be a TV advertisement, could be anything. Then you've got sales expenses. Here they call it technology and content, but we'll skip that for a second to stay with the coffee cup. You've got sales. You've got one person who works for you, and their salary goes here. Sales salaries to say, I pay this person 25 Naira to sell that cup. Okay. Then you got what we call general and administrative charges, which is the cost of doing the accounting records, the cost of lawyers, the cost of maybe rent. These things, what they call G&A. And then there's another group that's just called, other, which doesn't fit into those other categories. And so what you do when you build a profit and loss statement is you say, these are the important expenses for me, and they represent most of the expenses, and this is why I specifically identify them. Then the other ones that are left over are not that important, and they go in what they call this other section. And so you take the revenue minus those expenses, and you got what they call operating income. And the operating income is all that income or the money you've made after selling that cup and taking all the costs away. That's the operating income left over. That is your profit before you pay off things that are non-operating. So if you have a loan, you pay interest. That's non-operating. You might have income. You might have money that you get from the bank because you have some money on account and they pay you interest. Those are all non-operating, but there's still cash that goes in and goes out of the door. Okay, and so then you have that, and then so you take that income or that expense, you take it off the operating income to come down to what they call profit before tax. And that's how an investor will judge whether or not your business is robust. So if you're a startup, you can lose some money, but at some point they're going to look at your performance. Is it improving? And look at things called forecasts. I have this information. These are my actual profit and loss pieces of information, but here's what I forecast over the next year. That's also critical too. We call that budgeting. And you do budgeting in the same way you do reporting. So when you look at history, it's what we call reporting. But it's to use the same financial statement formats to do both. If you're doing budgeting, that's what you expect to happen in the future. And then you do comparisons against what you budgeted and against what you did the prior year. And so at the end of all this, you end up with the net income. Okay, again, you can forget about equity method of investments. That's, this is just an example. But you have what we call net income, and that goes into what we call retained earnings when we get to the balance sheet. Is there any questions on profit and loss statements and what you may want to do? Or may want to get some detail on, setting a P. We call it in shorthand a P&L, profit and loss. Is there any questions on how to set up a P&L?
So I see one hand up from GLAX. We're going to allow you to talk. I guess you have a question you'd like to ask. So 1 minute.
I see Winifred wants to have the slides and she has no idea. So yeah, we probably could share the slides.
So you would want to unmute yourself, GLAX, so you can talk if in case you have a question.
Sorry, that was a mistake. I didn't know I even touched the button.
Okay. And so I guess this is it. We don't have any questions so far. Terry.
I said Winifred looks like she wants to have the slides shared.
Oh yeah.
And I answered yes, I can share these slides. And I can actually, if somebody wants to do a very simple set of financial statements, I can also create a slide for that and explain in more detail each line item, so if that's helpful. And I know a lot of people shy away from this. I've been doing this for so many years. A lot of people don't like this because it's all numbers and it seems complicated. But I think people like to make people think it's complicated. It's really just easy. And if I had something else here, I would tell you how to actually create one. But again, there's some people joining for a mentoring session, and I'm going to go through how to actually create these. So they're easy for you. The one thing you should remember is that any financial statement that you put together should be something that's easy and visual for yourself to understand how your business is performing. And most of it is comparison against what you think you want to do, and most of it is what you've done historically, which means in 2010 or 2020 now. In 2019, I did 100,000 naira. In 2020, I did 200,000 naira. You want to keep track of that growth. That's what we call the healthy revenue growth. And this is one of the things that investors are going to want to see, especially on a startup. They're going to want to see what they call the top line. And the top line is the sales. Is your sales growing? And you use your profit and loss statement to demonstrate that. And then, let me see.
So there is a question, if you don't mind us
Go
stopping
right
you.
ahead.
So Ifeanyi, we're just going to bring you up. You can unmute your mic and ask the question.
Okay. Hello. Can you hear me properly?
Yes.
Okay. So I studied accounting in school, and I find it, even in school, I found it difficult to do accounting because the figures just keep messing with my head, and things weren't really straight with me. And then I'm in business and I have to do financial statements again. So what will you say is the first thing as a business owner?
What is? I'm
We
sorry.
didn't get the last part of the question. Can you ask it again?
Okay. So what will you say as a business owner that I am? What are the first things we should put in place so that the financial statement, when preparing it, would be very easy, for us to understand, for me as a business owner to understand it? Yes. So what are the things that must be in place? Yeah.
Well,
So,
if you,
Terry, I think what she's trying to ask, and I want to assume that she's probably speaking for everybody. And I agree with her too. When I did accounting in business school, it was like listening to French in class. So I guess what she's asking is what would be, so a layman, right? If I, for instance, wants to create a financial statement, because you can't have a business without doing accounting, right? So her question, I believe, would be what is the simplest way, right, to effectively do your accounting and financial statements so that you're not confused by all these figures that a typical accountant would understand one time, right? So she's asking what would be the simplest way to capture your financial statements in such a way that when I do it, I know I've done it right and I've captured everything I need to capture and I'm not confused, right? And I'm not doing creative accounting by mistake.
Yeah, the simplest way to do this is, and again, I don't know how detailed you get with respect to keeping track of your sales. Every time you sell something, write it down. And and again, I'm gonna get off this and I'm gonna do this real time. Okay. I'm gonna stop sharing my screen. I'm gonna share it back in a second. Okay. Okay, here we go. Give me 1 second and I will share the screen again and show you how to do this really quickly. Okay, can you all see this?
Yeah.
Okay, so I'm gonna go down here and find myself, I'm gonna go right here. Okay, so this is the profit and loss statement. Can you see it?
Maybe to go to, maybe to start presentation, slideshow.
No, I don't want to do a presentation.
Yeah, I understand. Okay.
Can you see this pretty well?
Mm-hmm.
Okay, I'm taking this out. I'm gonna start from scratch. Here's the easiest way to do this. And this is as simple as it is, and this is just as accurate. Did you see that? Can you see that?
Mm-hmm.
That is the simplest form of what we call a P&L. If you sell something, you record. Now, I would recommend that if you're a startup business, you do it on a monthly basis. So I sold something for $100. In the same month, and let's call it January, I spent $50 on stuff, buying the product, my rent, and all was $50. And so my profit for the month is $50. So you do this, you record it, and you put it away. Then you do the same thing for the next month. So this is January. So the next month you did $150. You spent $55. Let's call it $60. And your profit for the month is now $90. Okay? So this is February. So you do this for the month and you put it away. And so now you have January, which was 100 minus 50 for 50. February was 150 minus 60 for 90. And so then you have 250 what we call year to date. You have 110 in spend, okay? And then you have 140 in profit. Does that make sense?
Mm-hmm.
That is a profit and loss statement, and that is how you want to track it. Now, you may not have collected the money, and this is where a balance sheet comes in. This is where you keep what we call accounts receivable and accounts payable. We'll get to that later. But basically, I had a dress. I sold one dress for $100 in January. It cost me $50 to make the dress it costs me some money in rent, and let's just say your rent is $10 a month. And so in January, so you pay it by the year, but when you do the profit and loss statement, you only record 1/12 or 10. So you add all those spends up each month to see how much you're making monthly. And if you're a cash business, then your profit is basically your cash in the bank. If you buy things on credit or you sell things on a receivable, then the cash isn't going to be the same. But this is basically the same approach, whether it's cash or it's what we call a credit business. Does that make sense?
Yes, it does. And we also have a comment on the comment from one of the attendees. It says that it's actually clear.
That's all a profit and loss statement is. It gets more complicated as you start to grow and you start to have different types of spends that you want to keep track of. And that's why we have things that cost, because a spend for the product that you're going to resell is a different type of spend than the marketing that you may invest. Okay. And sometimes you want to have a simple profit and loss statement like this. And sometimes you want to have a more complicated profit and loss statement to keep track of different types of sales or different types of expenses. But end of the day, it's the same thing. I sold something, that's my revenue. I spent something to make that sale, that's my expense. The difference between the two is the money you make, the profit or income you've earned based on that effort. And if anybody tells you it's more complicated than that, they're lying to you because they want to trick you.
Okay, thank you so much. The feedback on the chat, even from Ifeanyi, is that it's clear. So thank you so much for the breakdown.
Okay, now I'm going to go to what they call the balance sheet. Now this is a little trickier because the profit statement is what we call a period statement, which means, like you say, you look at it in January, you look at it in February, you look at it for the full year. And once you're done, you start from zero again in recording the information. Because let's just stay on this example for a second. Let's assume that this is January 1st through December 31st, the 150, the 60, and the 90. So what you do at the end of the year is you take your profit and loss statement and set it back to zero, and you take that 90 and you record that to your balance sheet to keep track. This is what we call perpetuity, to keep track of the cumulative profits over the years. And so 2020, you made $90. 2020, and so that goes to the balance sheet as what we call retained earnings. Those are the earnings you made that were retained. Okay, and that's the cash, and it should loosely tied to the cash you have in the bank. So if I go to this next one, where is this one? This is what they call the balance sheet. Okay, it just keeps track of your business from the very first day of your business, and this never ever gets deleted. It always stays the same. And there's three things to this balance sheet. Okay, it's the assets. An asset is a positive. It's the things. Think of an asset like if you own a car. If you own a car, that car is worth 10,000 naira. That's your car. It goes on your balance sheet. You just record it as an asset. Here it's called property. Okay, and you might even want to call it a car. Now, and I'll do another example in this one too, by the way. But your car is worth 10,000. You basically own the car, so you put on your balance sheet 10,000. Now, you may have borrowed money to buy that car. So you may have paid cash. Let's say you paid 1,000 and you borrowed 9,000. So you now have a offsetting, what we call liability, and a liability is when you owe somebody something. So you owe the bank 9,000 naira because you paid 1,000 cash for the car. The car's worth 10,000. So on your balance sheet, the car goes on your balance sheet as 10,000. And then the offsetting 9,000 is what you owe the bank. And I'll do an example of that on the same example here. And the difference between the two is that you have an asset that's worth 1,000 more than the liability, and that goes in your equity section, what they call equity. So I got 10,000 naira asset in a car. I owe the bank 10,000. I owe the bank 9,000. The difference between the two is 1,000, and that's a positive to you, what they call equity. Does that
I
make
was
sense?
just wondering, right, if it's possible, maybe it would be easier for you to also open like an Excel sheet so that when you're talking about the left and the right side, it's easy. Your illustrations, like this car illustration, for instance. So let's say you have an Excel sheet open, and where does the 9,000 go, and then where does the 1,000 go?
Yes, I can do that. As a matter of fact, I will do that right now. Give me 1 second. Can you see the Excel spreadsheet?
Yes, we can.
Okay. Lohi has a balance sheet called Lohi's Wardrobe. And she just got a nice shiny new dress for $1,000. But Lohi didn't have the cash. And we're going to go up. This is the asset side here now, just so you know. And she had cash of, let's say, 1,000 in her bank account. But Lohi likes nice clothes, but she also likes to travel. And she wants that 1,000. So her assets are 2,000 for now, because she hasn't spent the money on anything. She just actually has the money, and she has the dress worth 1,000. So her assets are 2,000. But in order to buy that dress, she had to borrow money. And this is what we call liabilities. The liability over here, she borrowed 1,000. So Lohi said, "Hubby, can I have 1,000?" Hubby said, "No, I gotta buy myself a car, so no." So she went to her friend and borrowed 1,000. So her liabilities now are 1,000. So Lohi owns 2,000 of assets. She has 1,000 cash in the bank, and she has a new shiny dress that's worth 1,000. But because her hubby was so cheap, he wouldn't give her the money for the dress. She wouldn't borrow it. So now she has a liability. She owes somebody some money. So the difference between the two is 1,000, and that's her equity. That means she got 1,000 in cash, 1,000 in a dress, but she owes somebody 1,000. So now she simply has 1,000, what we call equity. And that's a balance sheet. It's in balance now because there's three components. Component one is the assets. Component two is the liabilities. And the difference between the three is component three, equity. And so Lohi's personal balance sheet is only worth 1,000 because she has 1,000 in cash, 1,000 in a brand new dress, which is also an asset, but she owes somebody 1,000 because she wanted to buy the dress with cash that somebody gave to her, in her equity, which means her net worth now is $1,000. Does that make sense?
Guys,
This one's a little trickier than the profit and loss statement, but once you understand it, it's pretty easy. Assets are the things you value. Liabilities are the things you owe people. The difference between the two is your net value, your net worth, or what we call equity.
Actually,
you can say, someone was going to say something.
so it's actually a bit tricky.
Okay, I'm reading something from Princess Mayan. Is the balance sheet strictly for the business, or does it record both money spent in and outside the business, i.e. my personal spending? You can combine them both to make it your business plus your personal, but my recommendation is to keep them separate. Does that make sense? Now, somebody said it's a bit tricky, so I'm going to stop and see how to make it a little less tricky. And the reason you want to keep your personal stuff different and distinct from your business stuff, so that you don't mix the two, so you can actually evaluate the performance of your business. If you mix your personal assets with your business assets, then it's very difficult to judge the performance of the business. Does that make sense?
Yeah.
Now, I heard somebody say it sounded a bit tricky. So can you explain yourself? And I can actually do another example again.
Julux, I think that's you. So could you maybe ask specifically what was unclear, so that...
Okay. My challenge was how we got to 1,000 equity, because if we had looked at the slide, we had a dress of 1,000 and we had cash of 1,000, which equals to $2,000. And so if you had 1,000 borrowed, which was your liability, I was expecting that we had 1,000 here and the other 1,000, making it 2,000. So I don't know where the other 1,000 for equity was coming from. I don't know if you can actually explain that better.
That's a really good question. And here's what happens. The asset, and I'm going to highlight this, think of this as the stuff that you actually own of value.
Okay.
Okay? So you have 2,000 of value. And that value is in two forms. One of it's cash in the bank, and the other one is the actual asset called a dress that's worth 1,000. So theoretically, you have $2,000 of assets, right?
Yes, sir.
So now over here, you have what we call liabilities. It's in green. That means you owe somebody something. So it's a liability. It's an obligation on your part. You haven't paid it yet. It exists. It's like a loan, but it's not yours. It's somebody else's.
Okay.
So when you say, okay, what's in yellow is what I own. What's in green is what I don't own, but I have possession of. So you always take the difference between the two to say here, the difference between the two is my net worth, because I own two items worth 1,000 apiece, and those are mine. But I also have an obligation that I owe somebody some money of 1,000, which is not mine, but it's in my possession, basically. And so if I take what I own and I subtract what I owe to somebody, then my net worth, my equity, the stuff that is net mine, is the 1,000.
Okay, sir.
Does that make sense?
Yes, sir.
And so this is important because when you start a business, you're going to need what we call liquidity. And that comes in the form, and so it's basically the cash you're going to need to stay solvent so you don't go bankrupt. And so you may not sell everything you make. It may take 30 days to 60 days to start the process of either making something or providing that service. And so you may find a client that says, you're going to sell me a service, and your service is consulting. And so you charge $1,000 a month, but your client tells you, oh, by the way, I'm only going to pay you 60 days after you finish. That means you spent, let's call your time spending. You spent $500, because let's say it costs you $500 for your time and effort, and you're going to generate $1,000 in revenue, but that person is not going to pay you for 60 days. Somewhere you need to cover that $500, and that's where liabilities come in. You go borrow the money. The bank gives you the $1,000 to cover your expenses until your customer pays you. And this is where the balance sheet becomes important, because that becomes the assets and liabilities, okay? Because if we go back, now let me see if I can go back here for 1 second, and you record this stuff, you can see the sheet here, right?
Mm-hmm.
Yes.
You see the line item called accounts receivable?
Yeah.
That is either your product or your service that you sold to somebody, but they didn't pay you the day you sold it to them. And this is where a balance sheet becomes important, because in a lot of businesses, you have to give credit. But by the same time, because you're giving credit to your customers, because as your business grows, you're going to go from a cash business to a credit business. So you'll sell your services, you'll sell your product, and you'll say, pay me in 30 days, pay me in 60 days. And then you go to the bank and you borrow money. So you see this thing called over here on the other side, notes payable.
Mm-hmm.
That's where you've actually gone out and borrowed money from a bank to actually help you generate your cash. And so if we go back to this simplistic view of the balance sheet here, this is where you record all of that. And so this is where the balance sheet becomes a little bit more complicated, but it's very useful because you keep track of how much money is owed to you and how much you owe to somebody else. And then the difference on equity is the difference between the two. As long as it's positive, you're doing okay. Does that
Okay.
make sense?
Yes.
When it goes negative, that's when you have a problem. And so there's different types of assets. There's cash, there's receivables, and then there's what we call equipment or property or housing. And you put it in a list from what we call the most liquid to the least liquid. Most liquid is cash. You can take cash immediately and spend it, right? You can spend it the very next minute. Accounts receivable is the next, what we call most liquid. You may have to wait 30 days to collect it in order to spend it. It's a representation of cash you don't have access to immediately. Then the third is what they call, and I'm going to use house for an example. You've got a house, it's worth $100,000, but you cannot turn that house into $100,000 on day one. You have to go find a realtor, you have to sell it, you have to collect it. So it might take you 5 months to turn that $100,000 worth of a house into $100,000 in cash, because cash is the most what we call liquid asset. Make sense?
Mm-hmm.
And then you have accounts payable, which is if you sell product, let's say you sell computers. So you go to Lenovo and you say, I want to buy 10 computers that I'm going to sell over the next 6 months. Can you give me 60 days of credit? That's what we call an accounts payable. That goes in the balance sheet. That's like this liability, borrowed money. same thing. If a vendor gives you a line of credit, it's like borrowing money. So you buy your computers from him, but you don't pay him. You say, I'm going to pay you in 60 days. Then you start selling them. And that goes into what they call the liability section. And so if you buy 100,000 worth of computers and they give you credit for 100,000 and you sell it for 120,000, you still owe 100,000. You've sold for 120 and you've collected the cash. Your equity's 20,000 because that's the difference between the two. Make sense?
Yes.
Do I sound passionate about this stuff? I sound like an accounting nerd.
I think it's simple enough. I think we got the drift of it. Thank you.
Okay. Now this one, the next one is a little tricky. This is what we call the cash flow statement. And this is when you actually take the profit and loss statement, what they call operating income, okay? And then you take the differences between the liabilities and the assets from period to period. Do you know what I mean? So I'm not going to get into a lot of detail on this, but I want to explain why this particular is important, and then when we get into some mentoring groups, we can actually build a cash flow statement. But this one's a little bit more difficult to understand. But this is the statement that makes sure that your profit and loss statement and your balance sheet are accurate. This ties the two of them together, because your balance sheet is what we call a perpetuity statement. You never stop it. You never go to zero on it. The numbers that keep on going into that statement always keep on going into that statement. The P&L at the end of every period, whether it's a month or a year, you zero it out and start new so you can see what's going on the next period. Okay? So the cash flow statement, as it says here, has several purposes. It links the P&L and the balance sheet together. It identifies your sources of cash and where they come from. The biggest source of cash that you should have on your cash flow statement should be from operating income. If you got a big amount of money coming in from operating income, that means you have a nice, viable, successful business. And then it talks about where you use your cash. So your sources of cash can be operating income, money from a bank, money you find in the street. Uses of cash can be you bought property, and so you record the differences. I had a house 100,000. I bought another one for 100,000. Now my use of cash in that period is an additional 100,000. At 100 plus another 100, 200,000. My use of cash was additional 100,000, bringing me down to 200,000 in an asset called houses. So this one gets a little complicated, but this is the one that links those two together. And then finally, when you do this whole cash on hand, this tells you how much you actually have on hand, which may not be what's in the bank, by the way, because money's always traveling back and forth. But it should be relatively close. Any questions? And again, this one I don't expect you to understand completely, but if you can get the concept of a profit and loss statement and a concept of balance sheet understood, this one will come naturally over time. It's not the most important one, because this is the one that just helps you to say your other two are correct, but this takes a little longer to learn. But what I do want to emphasize is the financial statements help you to keep track of your performance. It is a way to communicate your success or challenges. But what's really important for an investor, if we're talking about investors, is the founder of the business, the idea of what you're trying to sell, and the strategy or how you're going to do it. Those are the three critical pieces. And then the financial statements are there to help the investor understand it numerically and can actually look from, if they look from period to period, how well you've done over the last year or whatever it might be. And if you're a startup, you don't have history, so it's not as critical. So what's critical is that you understand how to keep track of things that you do. And so we can help build easy profit and loss statements and easy balance sheets to demonstrate that you have control over your assets, you have control over what you owe people, and you know how to use those to your advantage. That's the key for financial statements of a startup. What you do with your business, how you story tell your business, how you tell an investor, this is how it's going to go, and then you can demonstrate through your profit and loss statement how well you've done. That's just the icing on the cake. But it's you the investor is going to believe in. It's your product and service the investor is going to believe in. It's your key management team. If it's a small team, 1 or 2 people, doesn't matter if it's 1 or 2 or 10, they have to believe that the management team, the founder, the entrepreneur, and we're going to talk about entrepreneurs because most startups are usually 1 or 2 people, no more. They believe in the person. They believe in what the person is trying to do. Having the added information of a financial statements helps to give them a little extra confidence that not only do you have a vision, but you know how to control how you spend money and how you make money. Does that make sense?
Mm-hmm. Mm-hmm.
So what I'll do over the next day or two, because I know I have some mentors to do, we're gonna go through a practice of building the 2 most important statements, which is balance sheet, profit and loss and balance sheet, on a very simplistic level, so people can use those templates. And then we can talk about how to look underneath to keep track of the details underneath those. Does that make sense?
Yeah, it does. Thank you so much, Terry. Really amazing present. I mean, I wish I had it this simple when I was in business school, really. So thank you very much. This is great. So what the thing is, he's talking about his mentees. So he's going to build the sample account statement and cash flow statements for his team with his mentees, but this is what will happen. So we will share all of that same format that they build so that you guys can also have it. We will share it with the other mentorship groups. And before we bring today's session to an end, if you have further questions or you have comments or you need clarifications with something, please just drop them on the chat or on the Q&A. We will just hang around for about 5 more minutes and then before we end the session. Then there is one more thing. Danitza, the lady who's supposed to have the last session on the 28th of June, has asked if you guys can actually be online at 3:30. So please think about it and then let us know on the WhatsApp group. Once again, thank you for showing up for class today. We hope you learned something new. We hope you will be able to effect these accounting principles that you've just learned in your business and do it better. And Terry, thank you so much for being here, for supporting us, and for doing this. Guess what? If we were going to pay, we would not be able to pay him for this session. He's doing this session for free. So guys, this is priceless. And Terry, we just really want to say thank you for everything. So once you make your decision on when to meet your mentees, it will be communicated with them as well. Thank you. And you can see from the chat, there is a lot of thank yous coming in as well. So everyone appreciates you, Terry.
No, I appreciate it, and I love doing this. And you know, if anybody has any questions, please reach out to Lohi, and she'll get them to me, and I'll try to answer each and every question. Because one thing about the accounting that looks different depending on what type of business you're doing. So it's not like one template fits everything. So you have a basic template, but then you customize that template specifically for your business, because businesses are different. The real key is actually to track the performance, to measure the performance, and then see what needs to change, both for good and for bad. And that's what the financial statements are meant to help you do when you do the analysis against them. The real key comes in you being able to explain why the performance in the P&L looks the way it does. That's what the investor wants to know, that you understand your business and you can talk about it from the perspective of revenue, expenses, profit.
Awesome. Thank you so much. So guys, we're going to bring today's session to an end. We're glad you could join us. We hope you have a great week, and we will see you in the next class on Friday, the same time. Odie is going to be talking on diversification. So, all right, bye everybody.
Thank you.